Welcome to our session on raising external finance. In terms of session overview, funding is a very important part of the success story for any business, whether they're big, they're small, manufacturing, service. Funding is important. So having access to finance is crucial if firms are to survive and remain profitable. Normally, as firms grow, their internal sources of funding, like retained earnings, are no longer sufficient to fully fund their goals and objectives. So they have to reach out to the financial markets to raise funds. So for this session, what we're going to try to look at will be what will be the basic processes that will go into raising external finance from the financial market. Try to explain the regulatory environment for the issuing of securities and also learn to differentiate between private placements and public offers. Our outlines we follow, we're going to look at the background to raising finance, the building blocks, and then when it comes to issuing securities in practice, what it means to do private placements and public offers. Now, when it comes to raising or issuing securities to raise funds, we have the option of either raising debt or equity. And normally, we are raising this debt or equity because we want to fund projects that have positive NPVs. In raising the funds, we either go through a full-blown public flotation or we can go through the private placement route. When it comes to equity capital, we normally will raise that through an initial public offer, what we normally call an IPO, that is if it's going to the public, or we can have a private placement. Or we can actually have a seasoned issue or offering, what we call a rights issue, meaning that it's a follow-up by a firm that has already gone public the first time. In terms of debt capital, which is usually raised through a public offer or private placement as well, this is funds contributed by investors who represent a claim on assets or future economic benefits. In terms of the equity capital, it's in exchange for ownership rights. So those are become the owners, and debt capital literally become more of like creditors to the business entity. Now, this funding can either be a public offer for the debt or also a private placement. And there are times you can choose to structure it as a single issue or what we refer to as shelf registration, where you register a bunch, meaning that you have a series, and then at any point in time when you need the funds, once you have already completed all the registration concerning what should go into raising, you issue the needed securities as and when the funds are needed. Now, when it comes to equity capital and we want to go public, the first time we issue equity capital to the general public, we refer to that as the initial public offer. So the term reflects initial public offer. And that means that typically you're issuing to more than 50 people based on the relevant acts that controls companies. Now, the processes involved are these: that you take the strategic decision on why they need to raise funds and why they need to go public. Now, this gives you a clear sense of direction in how you're going to proceed. Now, this decision process and the whole process must be approved by the board of directors, which also means that you should have a board that is made up of the relevant skill set to be able to make the right decisions. It goes to the next stage of getting approval by the shareholders. Beyond that point, we go on to appoint advisors. Now, in appointing advisors, now this is supposed to be more like a collection of a consulting body, a consortium of expertise to help navigate the process of raising the funds. So we have the lead manager, sometimes referred to or captured as a transaction financial advisor or sponsoring broker. Now, this entity is responsible for ensuring that the issuing firm fulfills all the requirements of the Securities and Exchange Commission as well as the stock exchange if listing is also part of it. This entity provides direction to the issuer on the selection of other advisors, the legal, reporting accountant, marketing consultant. This entity coordinates all the activities required to complete the offer process, also provides input on how to price, the timing, and the distribution of the offer, either alone or with selling group. And this person or this entity also facilitates the relationship between the issuer and the regulators and ensures that they get or secure approvals, and is also responsible for preparing the offer prospectus. The legal advisor comes in to ensure that legal due diligence is conducted, so review all legal processes completed by the issuer to ensure that they comply with companies' regulations, if any, the Companies Act 2019, in this case the newest, the listing rules or the GSE or the GACS or any other body they want to list with, the Securities and Exchange Industry Law, and any other regulations that may be required by the issuer. There's also the reporting accountant who is responsible for financial due diligence. Now, this person or this entity reviews the past audited financial information, will validate the financial projections, because remember, the financial projections to a large extent also inform the need for the funding. So there's a need to validate and ensure that these are very solid. And then models for the issuer which impact its value and is required to be disclosed to investors. Then there's also the publicity and marketing consultant, if necessary. Now, this entity is to assist the issuer to communicate to potential investors and ensure or help as much as possible that they derive advertising mileage from the process. And then there's also the need to have a receiving bank, the escrow account holder, one central point that manages receipts from the offer. Now, the next stage after appointing advisors, which we've gone through the various advisors, is to prepare the offer document or prospectus. Now, this offer document or prospectus will contain the terms of the offer, compliance with regulatory requirements, contain certification of the legal advisor and reporting accountant, and then it also contains information on the pricing methodology, the discounted cash flow techniques, the net worth, market multiples. This allows others to also verify whether the information in there is good enough for them to make a decision. The next stage will be to secure approval from the SEC to go about the offer, and then the listing bodies to go on about listing. The next stage will be to build the books, and this is to collate relevant information about investor interest in the offer at hand. So selling the investment opportunity to investors. And also the last stage, if any, will be to list securities on the exchange for trading on the secondary market. Private placement for raising equity capital, which means the sale of equity securities to a restricted list of investors not exceeding 50 in number. There's really no need to register with the Securities and Exchange Commission. You can look to Act 992 for the full details. The process involved is similar to a public offer but has minor changes. For the legal requirements, for example, the company's own regulations together with the Companies Act would normally suffice. Disclosure requirements of SEC is a recent development. You're going to appoint advisors accordingly. Proceed to prepare placements, document or prospectus. Build the books by selling to selected investors. The main difference in procedure is there's no filing with GSE, no publicity and promotional activities whatsoever. That is what defines the private placement. And when it comes to debt capital, The number also holds not more than 50. The legal requirements, the company's regulations, the recent Company Act, the need to appoint advisors, prepare the placement document. So the same difference here, no filing with GST, no publicity. So one of the main differences with private placement, no publicity, and the number of investors cannot go beyond 50. That brings us to the end of our session on raising capital. Our next session will focus on venture capital as a source of funding and also the technicalities and issues around rights issue. See you in the next class.